Hey everyone, and welcome back to The Explainer. Let's just dive right in, shall we? Today we are taking a deep, highly analytical look at an anonymous expert report that absolutely dismantles the structural mechanisms of U.S. international taxation. Specifically, we're popping the hood on the complex and frankly often deeply misunderstood architecture designed to mitigate double taxation. Look, if you operate or earn any money across borders, you are actively dealing with competing jurisdictional claims on your income. So how does the system actually resolve this? Where are the hidden traps? We're going to completely strip away the surface level fluff today and strictly focus on the core mechanics and the uncompromising cause and effect relationships that govern this entire space.
Here is the roadmap for where we're headed today. First, global tax residency frameworks. Second, the tiebreaker logic cascade. Third, treaty rates versus statutory rates. Fourth, foreign tax credit mechanics. Fifth, scaling exclusions against credits. And finally, number 6, exhausting administrative tax remedies. Let's jump right into the first one.
All right, Section 1, Global Tax Residency Frameworks and the Systemic Threat of Double Taxation.
To really grasp the mechanics here, we have to establish the macro foundation first. The baseline assumption of the U.S. tax system is that your worldwide income is subject to domestic tax literally regardless of where it's earned or where you live. And because foreign jurisdictions are obviously going to tax income generated inside their own borders, we get this immediate systemic threat of double taxation. Without some kind of structural relief mechanism, cross-border economic activity would just be mathematically crushed. But, and this is a huge but, there is a definitive boundary to this relief, known as the foreign tax credit limitation. You can think of this limitation as a strict mathematical ceiling. The system is totally designed to alleviate double taxation on foreign income, sure, but it absolutely prohibits you from using high foreign taxes to offset your domestic tax obligations on domestic income. The credit is strictly capped at the domestic tax liability generated by that specific foreign income. The domestic system is absolutely not going to subsidize a high-tax foreign vacation for your capital. If the foreign tax happens to be higher than the domestic tax on that same income, you simply do not get to use the excess to lower your overall domestic tax bill, period.
Moving right along to Section 2, the tiebreaker logic cascade and how we resolve jurisdictional overlap.
So you might be wondering what actually happens when two totally different countries look at you and both claim you as a tax resident under their own domestic laws. Well, to resolve these competing claims, international tax treaties use this brilliant structural concept known as a tiebreaker logic cascade. You'll usually find this in Article 4 of most treaties. Notice the strict sequential hierarchy here. It acts as a definitive logic gate. You absolutely do not weigh all these factors at once. You evaluate them in strict order. Step 1. Where does the taxpayer have a permanent home? If you've got one in both countries, well, you're forced to move to Step 2. Where's your center of vital interests? Basically, where are your closest personal and economic ties? If that's somehow still a tie, we look at Step 3, your habitual abode. Spending equal time in both, then it's on to Step 4, nationality. And if you happen to be a dual national, we hit the final fail-safe Step 5, the competent authority. This is where the two nations literally have to sit down, negotiate, and mandate a singular residency. You simply cannot be a resident of both for treaty purposes. The cascade guarantees a singular legal outcome. Which brings us to Section 3, treaty rates versus statutory rates and defining legal liability. Once your residency is locked in, we have to look at the actual rates applied to your income. This reveals a really fascinating systemic interaction where international treaties actively override domestic statutory laws to cap your tax exposure. The absolutely crucial thing to understand here is the massive difference between statutory and treaty rates. By default, a foreign country might slap you with a statutory withholding rate, which is often a hefty uncapped 30% on investment income like dividends or interest. But an international tax treaty will actively cap that liability, frequently bringing it down to 15% or sometimes completely exempting it. The completely non-obvious insight here? Treaties don't just magically lower taxes as some nice convenient little bonus.
They mathematically dictate the absolute maximum allowable legal liability for tax credit purposes.
And guys, that leads to a massive hidden trap that literally catches countless taxpayers completely off guard. If you fail to explicitly invoke that lower treaty rate, the foreign entity is just going to shrug and withhold at the higher 30% statutory default. But here's the kicker. Because your actual legal liability under the treaty was only 15%, that extra 15% you just paid is legally considered a voluntary overpayment. It is permanently disqualified from being credited. There is no way the domestic tax system is going to absorb your administrative failure to invoke a treaty. It's pure cause and effect. You must claim the treaty rate to properly calculate your allowable foreign tax credit, otherwise that excess money is just gone.
Let's dive into Section 4, Foreign Tax Credit Mechanics, and the specific qualification thresholds.
Okay, we're gonna drill down even deeper into the micro-mechanics now. Listen, not every single payment you make to a foreign government magically qualifies as a creditable tax. There are incredibly strict mandatory thresholds acting as absolute gatekeepers here. For a foreign levy to even qualify, it has to pass a rigorous 4-part test. First up, the tax has to be formally imposed directly on you, the taxpayer. Second, it actually has to be paid or accrued. Third, and this ties perfectly back to what we just talked about with treaties, it must represent an actual legal tax liability. Again, no voluntary overpayments allowed. Finally, the fourth gate is what we call the dominant character test. It must be a net income tax, or a tax strictly in lieu of an income tax. That means it absolutely cannot be a fee for a specific economic benefit, like say purchasing property, extracting minerals, or buying services from that foreign government. It must be a compulsory payment based strictly on net realized income.
Timing mechanics also play a totally critical and honestly pretty unforgiving role in this entire framework. Taxpayers can claim the credit using the paid method, which is basically just a cash basis applying the credit in the specific year you actually handed the tax over. Or you can elect the accrued method, which applies when all the events have occurred that permanently fix the exact amount of your liability. But what you really need to grasp here is the strict permanence of that accrued method. Listen closely to this. Once you elect the accrued method, you are legally locked into it for all future years. There is literally no going back. Now, the expert report we're analyzing does highlight one very narrow, actionable exception. If a taxpayer has never ever claimed the foreign tax credit before, they are allowed a one-time, first-time switch to the accrued method on an amended return. It's exactly this kind of deeply buried structural detail that defines truly high-level tax planning. All right, Section 5, Scaling Exclusions Against Credits and Finding that Mathematical Equilibrium. We are now going to explore a really fascinating mathematical intersection of two totally different relief mechanisms, the Foreign Earned Income Exclusion and the Foreign Tax Credit. Let's walk through this formula together, because it represents a huge juncture in the tax code. If you utilize the Foreign Earned Income Exclusion to shield a chunk of your income from domestic tax, you absolutely cannot simultaneously take a tax credit for the foreign taxes paid on that exact same shielded income. This triggers a strict proportional reduction formula. You take your excluded earned income, subtract allocable expenses, and boom, that's your numerator. Then you divide that by your total foreign earned income minus unreimbursed expenses, which is your denominator. The result of that math gives you the exact percentage of foreign tax that is permanently disqualified from your credit calculation. Seriously, think of this as the ultimate anti-double dipping mechanism. It so brilliantly illustrates the absolute mathematical equilibrium of this whole framework. The system fundamentally prohibits you from generating two distinct tax benefits out of one single dollar of income. Cause and effect, right? If the income is mathematically removed from the domestic tax base via exclusion, then the foreign taxes tethered to that specific income must also be mathematically yanked right out of the credit pool. It's the only way to prevent artificial tax advantages and maintain the structural integrity of the entire global tax framework.
And finally, Section 6, Exhausting Administrative Tax Remedies for Actionable Resolution.
So, what happens when a foreign authority just messes up and overwithholds or incorrectly assesses a tax against you? Well, the expert analysis delivers this
incredibly uncompromising maxim. Taxpayers cannot claim credits for amounts paid to foreign taxing authorities when they have failed to exhaust all effective and practical remedies to reduce their liability. Basically, the ultimate burden of proof rests entirely on you, the taxpayer. You literally have to fight that foreign withholding on their turf before you can even think about seeking domestic relief.
You are fully expected to use acceptable structural channels to aggressively contest these liabilities. We're talking about pursuing foreign tax appeals, invoking those competent authority arrangements to get treaty provisions clarified, utilizing local amnesty programs, or, even litigating right in their foreign court systems. Now, to bring this theory back down to earth, the framework does actually allow for a reasonable business approach. Look, if fighting a $5 overcharge is going to cost you $5,000 in legal fees, no, you aren't forced to litigate. The system totally demands that you weigh the financial costs against your likelihood of actually winning. But simply ignoring an actionable remedy just because it's a bit inconvenient, that is absolutely not permitted.
So why in the world is this exhaustion of remedies so incredibly strict? Well, it represents the absolute bedrock of structural tax theory. Think about it. If the framework just handed out credits without forcing taxpayers to aggressively reduce their foreign obligations down to the absolute legal minimum, the cost of all those excessive or improper foreign taxes would essentially be subsidized by the domestic tax base. It would improperly shift global tax revenues right out of the US Treasury and directly into the pockets of foreign authorities. By forcing you, the taxpayer, to go out and fight the battle, the system brilliantly protects its own revenue base.
So, as we wrap up this incredibly deep dive, I really want to leave you with a crucial expert-level question so you can audit your own cross-border compliance. Have you ensured that your international tax strategy actually relies on treaty-defined legal liability rather than just blindly accepting default statutory withholding? Because as we've clearly seen today, the architecture of global taxation is totally unforgiving. What you don't know about the mechanics of international taxation won't just confuse you, it will permanently, literally cost you. Thanks so much for joining me on this explainer, and remember to always keep questioning the mechanics behind the rules. Catch you next time.